bearish on stocks. I'm bullish on a tail event. I still think the reverse carry trade could be a spark. Yen's only now starting to move. But it's unclear how policy volatility is ultimately going to impact equity volatility. You would think that it should be a one-for-one type of dynamic. We will get to a point at some point where the AI spend and the AI narrative is going to have to result in margin increases for the users of AI, which should be small caps and mid caps. Otherwise, it's one of those things where, yeah, sure, it's nice to be able to have a chat bot and it's nice to be able to create images on the fly, but is it actually impacting the bottom line for companies? So I don't know. I remain skeptical of not just that narrative, but most narratives. When an investment becomes a religion, it's time to lose faith.
Hello and welcome to the Achieving Alpha podcast. My name is Stephen. I'm the host of the show. Today, I'm delighted to be joined by Michael Guyard. He is the founder of the League Lag Report, and it is a pleasure to have you on the podcast today, Michael. How are you?
I'm good. I wish I had more time, unfortunately, so we could have a nice long conversation, but I'm surviving. I'm hanging in there.
Sure. We'll save the long conversation for next time, when you have a bit more time and we can go into some more topics. All right, excellent. So today I wanted to talk about some of the things that have been happening in the market, some of the topical issues. It's been a bit of a crazy start to the year, quite volatile. And then I wanted to talk more about your market outlook and how you're positioned in the market. And then we can talk about some other topical areas. So, Michael, how are things going in the market for you? What's your current viewpoint on the market and some of the things that are happening? And I'm thinking in particular about some of the stuff that have happened since Trump's presidency, such as the tariffs and some of the drama around making Canada the 51st state and Greenland, etc. So what are your views of how the market has started at the beginning of 2025?
Well, it's a little bit of what we've seen last year, right? Which is to say that it's still an AI story, right? In terms of what's driving whatever momentum there is. But it does seem like the market, if you define that as the S&P 500, is broadly not really making too much headway. If I just look at a quick chart, it looks like a series of higher lows starting to form, at least on the daily. And small caps continue to struggle, right? Despite hopes around a reinvigorating economy. A large part of that obviously is because of still ongoing concerns around higher for longer rates, and the inflation and labor data suggests that's likely still going to be an issue, right? That rates will still stay likely elevated. So I don't know. I think it's unclear to have that much confidence in terms of what comes next. I do believe that small caps and mid caps likely outperform this year, largely because I think deregulation is going to be a catalyst for that. And I still very much maintain that there's a tail event out there. I keep saying that line, bearish on stocks. I'm bullish on a tail event. I still think the reverse carry trade could be a spark. Yen's only now starting to move. But it's unclear how policy volatility is ultimately going to impact equity volatility. You would think that it should be a one-for-one type of dynamic. It may not be, honestly. And we've seen from the most recent headlines and back and forth when it comes to tariffs that Trump will threaten something, and because other countries are afraid of him executing on it, they tend to then come to the negotiating table.
Yeah, so you think it's more of like a negotiating way to strong arm the other countries into getting what he wants at the end of the deal?
Yeah, I mean, until it isn't, right? And until he then has to pull through. And maybe he does pull through with China, right? Which, compared to every other country, is the one that he's focused on the most on his first term. So I think, look, it would be abnormal, although you can argue it's all been abnormal. It would be abnormal to have a third year that's as strong as the last two. And I think we're due for some broadening out of momentum. But who knows, right? It's like this has been such a weird cycle where most stocks are still actually below their inflation-adjusted 2021 highs. Certainly not the Qs or the NASDAQ or the S&P, because they're market cap weighted to a select number of large cap tech stocks. Meta being up a historic run as that streak continues. So we're in uncharted territories from a path perspective.
And what are your views, obviously, on some of the AI plays? Obviously, AI has been last year steamed away with things. You had NVIDIA that went through the roof. And then we started 2025, a little bit up and down, there's a lot of volatility going on. Do you expect some of that AI play to fade away as 2025 progresses, or do you think it's more of a long-term play?
Look, I mean, I've been dead wrong about Nvidia for some time. What I will say though is, for whatever it's worth, you look at the chart in Nvidia, and I'm not a squiggle boy as I like to call them on the technical side, but that looks like a big topping pattern. I could be totally wrong, right? But I think a lot of the momentum around Nvidia seems like it stopped really in June of last year, and since then it's been treading water. We will get to a point at some point where the AI spend and the AI narrative is going to have to result in margin increases for the users of AI, which should be small caps and mid caps. Um, Otherwise, it's one of those things where, yeah, sure, it's nice to be able to have a chat bot and it's nice to be able to create images on the fly, but is it actually impacting the bottom line for companies? So I don't know. I remain skeptical of not just that narrative, but most narratives. And I would caution anybody who thinks that this time is different, that this is the fourth industrial revolution. Yeah, maybe it is, but it could also not be the case. And if everybody's saying the same thing, probably it's a crowded space to not consider playing in.
Yeah, it's extremely hard, isn't it, Michael, to be able to time when these things. You know that there's a lot of momentum. You know that there's a lot of hype in the market. You know that the valuations are really frothy, but to be able to time when they go down and when the enthusiasm's going to wane, it's almost an impossible task, I think.
Yeah, well, that's why I always. So the analogy I always give is, I don't know the mile marker that I might crash my car, but I know the conditions that favor the accident, right? So you can argue that high valuations are a condition. You can argue that when you're below moving average, it's a condition, because yeah, you can time it based on the moving average, but the truth is that could still be wrong, right? You could get whipsawed, you could get a false signal. So, to me, it's more just something to consider in the backdrop as far as how much risk anybody should take in any particular investment idea.
Yeah, totally agree with that. Okay, and do you think that the potential reduction in interest rates are going to help tech stocks as we move in 2025? Do you think it's going to make much difference, or do you think that's been mostly priced in?
Yeah, probably priced in. Look, I mean, if rate cuts are happening, as I've noted on X before, it probably means that things are slowing down pretty aggressively. Right. This most recent one seems to obviously have been the opposite. The Fed maybe lowered rates because the government's going to have to roll over a bunch of debt in terms of short-term paper this year. But typically, if you're at the start of a rate cutting cycle, the bulk of volatility and a drawdown happens in stocks. And where is that going to be centered? It's going to be centered around tech stocks because those have been the biggest winners, right? So people sell the biggest winners before they sell their losers. That's a behavioral bias called the disposition effect. So maybe fundamentally they benefit, but I think market reaction would probably not be all that positive.
Yeah, agree with that. Okay, and what's your market outlook for the year? So we're into February now. January's out of the way. January is usually when people come up with these either predictions or their outlook for the year. But a little bit of time's passed since then. How are you positioned for the market at the moment, and what are your key plays for 2025? And what are you expecting from the market? And maybe any dangers that you can see as well.
Yeah, I mean, well, to be clear, when you say position, it's not one of those things where I necessarily am positioning based on my thoughts for my own funds, which are mutual fund and ETFs. They're rules based with a very specific opportunity set, which candidly has not been beneficial at all in this cycle, especially using treasuries as the risk off safe haven option. Having said that, I do think treasuries will act as the safe haven risk off option again. I do think outside of what I'm doing from a product development perspective, I still think gold is going to continue. That I've been, for all the insanity of people misunderstanding my analysis entirely, I've been wildly bullish on two areas of the investment landscape: utilities and gold. Right, utilities on the stock side, and then gold, obviously, on the commodity side. I still think there's a lot of room for both. Right, utilities more on a relative basis, gold on an absolute basis, and they've done really quite well, independent of not necessarily having exposure to AI and Max 7. I suspect that, again, I go back to this deregulation concept. If Trump is serious about deregulation, there should be a lot of big opportunities coming. We will see if he's serious about deregulation. I suspect he is. That, to me, is the next big investment theme. last year I'd argue was a hybrid of defensive posturing plus AI positioning with utilities, right? I mean, utilities are the most defensive sector of the stock market because of the link to bonds. And obviously, with the surging demand for energy and electricity, right, utilities benefit from the AI side, especially if you have any nuclear as part of that. If the AI story subsides and if credit spreads widen, then any utilities momentum is going to be more safe haven driven than AI driven, which would take it back to the way historically utilities outperformed the market. And I don't think anybody's really prepared for that.
Okay. All right, excellent. So obviously on utilities, what is your feeling behind that? What's driving you to think that utilities will do pretty well this year?
Yeah, I mean, on a relative basis, clearly. I don't know if it's going to be small caps on an absolute basis, but I think relative small caps are due for outperformance. I go back to deregulation should most benefit small cap margins, right? Because you're taking a regulatory burden off the balance sheet, um, off the income statement. So I think that could be a really interesting catalyst. I think if you get the irony of all this is that if you get any kind of real risk off phase, which results in yields dropping, that saves small caps. So I'd argue you need to have stocks, especially large caps, drop heavy to save the small cap companies as ongoing concerns, because then they're going to refinance into lower rates as that flight to safety pushes yields lower. And I think it's a very unloved part of the marketplace. I mean, I'm a fan of things which nobody else is really investing in conceptually, right? Outside of the narrative and the momentum at the moment.
Yeah. And do you think if, for example, if the market did drop this year in 2025, do you think that the small caps would hold up relatively well? Or do you think that they would have potentially a higher beta than other positions?
Again, I think it'll depend on yields in that sequence, right? Because we've seen, right, as yields have risen and stocks have gone down, small caps are down more. So you need to have yields drop and then see if small caps are actually responding to that, meaning they'd be down less, right? Which I think is probably the more likely scenario. Small cap cycles, when they outperform, they tend to outperform by being down less, meaning they tend to outperform in bear markets, which is the irony, right? Um, so yeah, I think oddly enough, it's like if you're going to play defensive cap equity, you probably want to tilt smaller, which is a weird way of framing it, but historically, that there's just a truism there.
Yeah. No, that's really interesting. A lot of people would think that small caps would drop by more if during times of a bear market, but you're right. If we look at history, they hold up better in the grand scheme of things. Okay, and Bitcoin. I know that you have mixed views on Bitcoin. I think people think on X that you are a hater of Bitcoin and crypto, but I don't think that's the case. I've heard past interviews of you talking about it. Obviously, Bitcoin hit all-time highs at the beginning of the year. Pull back slightly. We're looking at just under 100,000 at the moment, 97, 98,000. What is your outlook for Bitcoin for 2025? And do you think it could have some longer to run, or do you think it's an overcrowded market? What's your views?
Do people really think on X? Like, I don't know about that. Yeah, I mean, I don't know. I'm still waiting for that God candle everyone promised me when the ETFs came out.
Call it the Amiga candle, I heard.
Yeah, I've used that line so many times before. Yeah, especially when things get exuberant. That when an investment becomes a religion, it's time to lose faith. I've said that at other major short term tops in Bitcoin, and obviously it kept on going higher. So people were like, "Oh, you're saying doesn't mean anything." Okay, yeah, but it's still about the point of it remains the same. It's about it being a crowded trade, right? When the church is full, right, on the belief in Bitcoin. Um, I don't know. I mean, I've said that line before. Initially, I said Bitcoin will diverge in October of 2023, and more recently, I've been saying Bitcoin will converge. And when I say converge, what I'm addressing there is converge to the Nasdaq, right? Meaning, I'm sure you've seen that chart before that Tavi Costa put out. 3 times Qs looks exactly like Bitcoin. Um, you know, now maybe it does diverge, and maybe it does act as a safe haven, but I don't think that's the case.
Yeah, I think there's been a lot of buying from obviously the ETFs that were launched, and we've seen a lot of kind of institutional investors and people getting a position in Bitcoin specifically. But it doesn't seem to me, just from a personal point of view, that all the retail crowd are completely back. Doesn't seem as frothy as it was in 2021, for example. Yeah.
So I agree with you on Bitcoin. I disagree with the idea that the retail crowd's not back. I mean, you saw it with the silliness around Fartcoin and Trump and Melania, like all these things, which are just like clearly absurd gambling tokens. They may not be gambling on Bitcoin, but they're definitely gambling somewhere else.
No, I agree with you on the meme coins. They are getting a bit ridiculous, and there is so many. It's so easy to set up a meme coin these days. You can do it in just an hour and try and get a community behind it. So there is some frothiness on that. But I think what I meant by that comment was that they haven't completely come back into Bitcoin and some of the larger cap.
Yeah.
All right, excellent. And I know that you've got some strong views, and I've seen on your X about Japan and the carry trade. Obviously, that blew up last year. But from your X, I can see that you still have some concerns about Japan. And I just wanted you to, elaborate a little bit on what your concerns are and what you think could happen if it does blow up again.
I mean, look, I don't understand why people say, how can you think it's not over or people have to prepare for it? Because it's still profitable. You can still borrow from Japan and make money, but deploying it anywhere else in the world. They haven't raised rates enough for that dynamic to totally change. And the yen's been weaker, which has helped you as a borrower. So of course the carry trade's still going on because it's still profitable until it's not. Right? So it's just funny to me how people don't seem to understand that, which is ironic because I always say if you understand this. I keep going back to Japan. Do you think Japan's going to have to panic at some point? I mean, you can see that with their own 20-year yield or 10. What was it? I think 20-year yield got to 2% or 10-year yield got to 2%. BOJ is going to have to follow that pretty aggressively, I think. And I keep going back to the last time we saw it, August 3rd, August 5th, you had a pretty severe disruption. Now, you don't necessarily have to have a disruption that's quick next time around. Maybe it's more like a traditional elongated type of decline, right, that the reverse carry trade results in. But no, I don't think it's over by a long shot. I still think it's very much a real risk, and that's another source of potential tail event potential. But I could be wrong, right? It's like it happened for 2 days. Everyone high-fived me. I myself said, I bet you the market's going to rally very hard now. It did. And everyone now says, well, reverse carry trades is a nothing burger. It's not going to happen again. Well, maybe because everyone now is ignoring it, it could matter again. It's always hard to tell, but I think if oil starts to really move in a big way on the upside, then that would be the spark. Because I keep going back to the thesis relies on oil priced in yen, causing them to have to force the yen higher to counter the oil's price appreciation in US dollars. Right? So I think all eyes on oil are a big part of this sort of scenario.
How could an investor potentially position for that? Obviously, I'm not talking about your individual trades or what you're currently doing, but how could you potentially benefit from potentially the reverse carry trade playing out on a bigger scale?
Yeah, I mean the simplest answer is the right one, which is just the yen itself, because reverse carry trade would result in the yen appreciating against the dollar. And then I think long duration treasuries and gold would probably benefit as well. Again, it's a flight to safety. When the reverse carry trade was playing out August 3rd, August 5th, treasuries were acting like a flight to safety trade again. It didn't last very long. And that's part of my thesis, right? It's like whenever I put out on X the Doctor Strange, which I've now put my face on, or at least a friend of mine made a video of that and put my face on it. When I do that with the one outcome from Doctor Strange, I then put the phoenix, the flag of Japan, and then the phoenix being the representation of flight to safety trade and treasuries. Part of the thesis is that's going to spark the credit event that I've been dead wrong on also, right? That it creates the volatility spike that results in junk debt breaking, which results in a flight to safety back into treasuries because everyone's saying, well, look at Japan and what their government's going through now with their debt load against inflation and rates. But again, I could be wrong. I've been more than humbled in the last several years in this cycle, which has been painful and frustrating to say the least.
We're all wrong from time to time. It's just that some of the joys of playing in the market.
Tell that to the deep thinkers on X.
Yeah, that's true. Yeah, but that does actually make sense with what we were talking about earlier about potential positioning. You were quite bullish on utilities and also gold, which would fit into that thesis of Japan as well. Okay, and I've also heard you mention something that you like to look at in the past called the gold to lumber ratio. Just for people that aren't familiar with this link between the two, could you just first of all explain what it is, and then second of all explain what is the gold to lumber ratio now, and what is it telling us?
Yeah, it's funny to me that people don't even look at the research. They just say this sounds stupid. And they say that they're posting from their house, which is made of lumber. It's very simple, right? It's just like no different than how copper is a tell on industrial activity and gold is your safe haven commodity. Lumber is your tell on housing. Full stop. Typically, and people also misunderstand because they're not actually looking at the research itself. Lumber to gold tells you about volatility likely rising or falling. So if lumber is outperforming gold, it's not an opinion; it is outright fact. You pull an Excel spreadsheet, you can do the data work yourself. Right? Lumber outperforms gold. The volatility for stocks tends to fall afterwards because lumber doing better than gold means housing is about to pick up, or at least construction is about to pick up. That's just bullish liquidity. If gold's outperforming lumber, it's defensive, and historically volatility tends to rise afterwards for stocks. Again, not my opinion. These people who just they think it's what I've gone through the last 3.5 years is because of the signal. No, the signal tells you about volatility. The question then becomes how do you execute on the signal telling you about volatility? Typically, the best way to do that is through treasuries, except in this cycle, right? Which again, I'm blown away at how and people just like repost and like things that are blatantly, stupidly wrong and actually quite hurtful, right, from a lot of perspectives, right? And it's just mind numbing how this stuff goes viral. So, which is yeah. Anyway, more of a side note, but no, that's the concept. It's not overly. Now, again, this has been a weird cycle for treasuries. Had to use lumber to gold and instead use gold instead of treasuries with the exact same timing for risk on, risk off. You'd have a very different return pattern, right? Because gold has acted as a much better safe haven play and one that's actually benefited, even though you haven't really had any severe volatility spike.
Yeah. So what is it exactly showing now in terms of the gold to lumber ratio? Is there any signals that you can get from it from what's happening like right now at this period, or is it too short?
Yeah, it's mixed. I mean, it's based on what look back period you're looking at, obviously, but it's not. You can argue that the ratio was correct in that one of the other implications of gold outperforming lumber is typically that large caps outperform small caps, which has been the case, right? And typically, when lumber is outperforming gold, small caps do better because again, the link to housing is there, right? But yeah, on it candidly, there's no real clear direction at this point.
All right. Michael, I know that you've got to get going in a minute because you're very busy, but I just wanted to ask you before we wrap up how people can find out a bit more about you. Maybe you can talk a little bit more about the lead lag report and more about your podcast as well.
Yeah, I appreciate it. So at Lead Lag Report on X, Instagram, LinkedIn, YouTube, which is where my podcast Lead Lag Live also lives. And then the Lead Lag Report's on leadlagreport.com as well as on leadlagreport.substack.com. I'm available. I'm around pretty much everywhere trying to work as hard as I can and hustle as much as I can until the cycle comes my way again.
Yeah, definitely. I like your X. It's both informative, but also entertaining as well. There's a touch of humor in there. So,
Yeah, people, if you understand this. Yeah, exactly.
all right. Well, great to have you on the podcast today. It was really interesting. I hope next time we get a bit longer so we can go a bit more in depth on a number of different subjects. But really enjoyed today, and let's chat again soon.
All right, I appreciate the invite.
Thank you, Michael.